and gentlemen, welcome to our class today, revision class. We are going to revise valuation concepts in finance. We'll be looking at a past paper question that was examined in December 2013, question 2b. And I know you have your calculator, you have your notebook, you have a pen and 2 pens for that matter. You need to have 2 pens. You also have the discounting tables. Discounting tables will be discounting future cash flows in this question. So I'll right away go into the question. Question December 2013, question 2b. I read, Mongo Limited currently pays a dividend of 4 shillings per share. The dividend is expected to grow at 15% per annum for the first 3 years, then at 10% per annum for the next 3 years, after which the dividend will grow at 5% per annum to perpetuity. The required rate of return for the ordinary share is 18%. Required, the intrinsic value of the ordinary share. We are required to calculate the intrinsic value of the ordinary share. That's a question. And as usual, I've always told you, before you attempt a question, you need to read it again so that you can be able to understand the terms that are used in the question. Remember, you are told to calculate the intrinsic value of the ordinary share. Intrinsic value, okay? As a good student, you need to first of all understand what is intrinsic value. What do we mean by intrinsic value? That is the question. Then from the data you are given information as far as a dividend is concerned. And by now you know what a dividend is. A dividend is simply a return on investment in ordinary shares. When you buy a share from a company, you are expecting dividends. You are expecting a return. Return on investment in shares is known as a dividend. So Mongo Limited is a company that issued shares to shareholders. So those who are holding shares in Mongo Limited, you are told in sentence 1 that they are being paid a dividend of 4 shillings per share. So that is the return that the shareholders are getting for investing in Mongo Limited. Then the second sentence we read, we are told the dividend is expected to grow at 15% per annum for the first 3 years. Year 1, it will grow at 15%. Year 2, it will grow at 15%. Year 3, it will grow at 15%. You are also told, then at 10% per annum for the next 3 years. So that is from the 4th year, it will grow at 10%. After 5 years, it will grow at 10%. After 6 years, it also grow at 10%. Then after the 6 years, we are told that the dividend will grow at 5% per annum to perpetuity. Per annum to perpetuity. What do we mean by perpetuity? Perpetuity simply means forever. The dividend after 7 years, it will grow at 5% per annum forever. Okay? Continuously. It will be, after 7 years, the return will be 5%, 5%, 5%, 5% to perpetuity. So that is the question. And you are told the required rate of return of the company, of the ordinary share, is 18%. This is the cost of the dividend. We are told is 18%. Then we can now calculate intrinsic value. But what is intrinsic value? That's a good question. Don't forget we are revising. This we covered in our normal class. Remember we said that intrinsic value of anything or something is that value of that thing of itself. Okay? It is the value of a thing in its own right. All right? Extrinsic value is a value that is not intrinsic. Here, remember, we are talking about intrinsic. We may also have extrinsic value. And this concept is used in many areas, many fields. We have intrinsic value even in philosophy. Philosophers talk of intrinsic value. If you are, or in ethics, we have intrinsic value in ethics. In ethics, you may find determination of intrinsic value of a person. Okay, intrinsic value of a person. So this term can be used in many fields. But remember, we are discussing finance. Valuation. What is intrinsic value in finance? We are saying intrinsic value, we refer to the value of a stock or a value of a currency or a product which is determined through fundamental analysis. And I also remind you, fundamental value is the same as intrinsic value. When you are talking about intrinsic value, we are referring to the fundamental value. So as far as this question is concerned, we are supposed to calculate the intrinsic value of the ordinary share. Intrinsic value of the ordinary share. Under normal circumstances, you are all aware how the value of a share is determined. The value of a share is determined in the same way the value of any other commodity may be determined. For example, what you may ask, I may ask, what is the value of a tomato? Tomatoes. If you want to find the value of a tomato, that is now the market price of a tomato. How do you determine it? How is it determined? The value of tomato or the value of this calculator is determined by the forces of demand and supply. The forces of demand and supply. Helps us determine the market price of any product or service. Okay? So when we're talking about the market value of a share, then it means we need to go to the market where shares are bought and sold. And shares or stocks are bought and sold at the stock exchange. So the market price of a share will be determined through the forces of demand and supply at the stock exchange. That's important. That is market price. That is extrinsic value. But in this case, you are supposed to determine the intrinsic value, not the market price. It's the intrinsic value of a share. And I repeat, the intrinsic value of something is said to be that value of something in its own right or of itself. There are no external factors as far as intrinsic value is concerned. There are no external factors. We are talking about intrinsic value. Now, when valuing shares or stocks, we determine the intrinsic value. We determine the intrinsic value by simply discounting the future cash flows of the dividend. We determine the intrinsic value by calculating the present value of all expected future net cash flows to the company. Okay? So it is calculated by discounting all the expected future cash flows, So when you are talking about the intrinsic value of a share, we are going to just calculate the money that may be received in future, expected money that may be received in future. We discount the money. From this question, for example, you are told that the dividend is expected to grow at 15%. Okay? And we are given the dividend per share, the current dividend per share we are told is 4 shillings. Okay? So we can calculate the future value of this dividend after 1 year. And that's what we are going to do. We are going to determine the future cash flows of this dividend. Then after we have done that, we simply discount. That is our assignment. And we are going to do that right away.